Hello, everyone, and welcome to the Upside Ticker Talk. Today is June 17th. Summer is rolling around. We just wrapped up F1 Grand Prix. The Canadians are out of the playoffs. It's a little bit of a grim time, but we've got festival season coming up, so it's really a good time to be in Montreal and just across Canada as well as we're celebrating World Cup festivities. We've got a very exciting episode today. We're joined by a very special guest, which I'll be introducing in just a minute. But as always, just recapping our last episode in which we were doing a special one-time event, hopefully not a one-time we can redo again, but we were in Scottsdale for one of our due diligence events with advisors joining us from across Canada down in Arizona. And we took advantage of the situation and had a bunch of different guests join us, some of our portfolio managers giving their thoughts on the market, some of their positioning in their funds, as well as getting some industry experts like Mark Virilli, who's on our ETF team. And so that was a great episode. You can catch that. It's kind of like a mashup of multiple segments on YouTube, your favorite podcast app, as always. So, Valerie, thank you for joining us. Valerie is Director, Institutional ETF Sales and Strategy at RBC. Valerie has a background in trading. It's been a current role for about 6 years now. We've had the pleasure of seeing you on many different news outlets, including BNN, CNBC, Bloomberg, where you're a guest speaker for industry expertise, if you will, in ETFs. So we're very lucky to have you today in our studio.
Well, great. Thank you so much for having me. It's a beautiful day in Montreal.
Absolutely. And I know it's a busy time of the year and we're kind of trying to wrap things up. So we really appreciate your time. And I think it's going to be a fun episode because we have the chance to talk to industry experts as well, but we end up having a lot of Fidelity content as well. So it's going to be nice to get some perspectives from obviously Canada's largest bank. So it's going to be some good stuff. Before we get started on some questions, I'll run through some of the last month industry trends. So as always, we kind of run through what's been popular, what's been sold, what are we seeing from a flows perspective. And I guess I'll start off right off the hop. Another great month in May. So we had about $13.5 billion in net new assets coming into the industry. That's followed up from an April, which we saw about the same number of about $13 billion. A bit less than the $20 billion average that we were seeing clip, if you will, for the first 3 months of the year. But still, we're right around $86 billion, which is, if you look at the last 3 years at this kind of same moment of time, if you will, or end of May, at 2024, we were at about 24 billion, 25 was 48 billion, and now we're at 86. So it's almost like double, and it seems like there's no signs of slowing down for the ETF industry. From an asset class perspective, equities continue to lead the way. I don't think that's quite a surprise, just given the performance that we've seen, especially since the end of March. U.S. markets recovering very rapidly, emerging markets also doing very well. Canadian and international equities kind of doing their thing as well. So equities came in right around $8.5 billion. Global equity products being the most popular category, which is actually a little bit of a shift as international is kind of slowly taking a step back. I feel like we've talked about international for the last 14 episodes that we've done as one of the most consistent categories, but that's slowed down a little bit. Emerging markets, I did make a note of emerging markets because if you look at like broad market cap weighted indices for April and May, it's actually the best performing markets. Yet we saw 11 million of outflows in May for emerging market equity ETFs. So not a ton of demand, but maybe that's being captured through some of these global products as well. Other things I noted, thematics made a good push in the month of May, 655 million for the month. That came in the form of some of the active products as well as some of ESG products. That's bringing the year-to-date total to around 2.3 billion. Obviously, always got to highlight the multi-asset stuff because we spend way too much time and a lot of our time at Fidelity focusing in on that. That category is just another, consecutive month of over $1 billion in net new assets coming in, about 1.2 in May, capturing about 10% of the total ETF industry this year. So really quite a feat for a smaller category or smaller piece of the pie. Last thing I had here, fixed income had a bit of a bounce back because April was terribly slow. Albeit in May, we did see about 3 billion in net new assets, but really focused more on the kind of short duration, real return, target date bond mandates. So not really anybody willing to dip their toes seemingly on duration yet, albeit maybe with the announcement that there should be some resolution in conflict in Iran. Yields have slowly started to climb back down. Maybe that creates a bit of sense of optimism. But Valerie, I'll pass it over to you. I've enumerated a number of different things there. Is there anything that stuck out or anything that you've noticed on your end in terms of trends over the past couple months?
Yeah, it's definitely, I'm a broken record of records at this point. It's absolutely bananas every month. And I think we hit the 2024 fund flows record in April of this year. 2025 fund flows should be hit in the upcoming month. And then so 2026, again, is going to be on track to be absolutely incredible year in terms of ETF fund flows. Yeah. In terms of recent, we've definitely seen a big move back into U.S. equities, especially Canadians buying U.S. We had this nice surge. We had this nice gold bull run. So we saw, I think, a little bit of a rotation, Canadians buying Canada again, and Canada did outperform. But really coming off of the March lows, we've got this AI trade, AI earnings looking very robust. We just had a very strong earnings season. And the economy looks like it's kind of chugging along, and the story is really about growth. And right now that is still centered in U.S. equities. So a big pivot back there. And then in terms of, talking again about international versus global and thematic, I think there's definitely been a rotation there towards thematic, and maybe out of kind of the single country or kind of Asian or let's say more specific geographic targets, and pulling into the theme instead of the geography itself.
Interesting. I like the point you made with regards to Canada, right? Because like last year, albeit like the Canadian market had a really good year, it was fairly focused, or concentrated, like similar to what we've seen in the US over the past couple of years, where it was like, it was the Mag 7, then we called them the hyperscalers, then we call them whatever we'll call them next. It's the same types of bundle of companies. But last year, like if you didn't have a market weight or overweight position to gold, it was a fairly tough year. So like on your end, did you see appetite for, yes, the broad market stuff, just saying like, I'll buy the TSX because I know there's quite a bit in there, but like, was there demand for maybe more sector focused in precious metals, or even like commodity, direct gold basically exposure? Is that something that you guys saw? And is that continued into this year, or like you mentioned, it's maybe phasing out a little bit?
To me, this was like the 2025 story. It was gold continuing to rally. There's kind of nothing emanating that's going to slow down. Pushed into metals and miners, of course. And then I had a very early boss a long time ago in my career that said Canadian banks are God's gift to the Canadian market. Okay. And of course, the Canadian banks have been absolutely on fuego as well. We even had our Canadian bank analyst come down and talk to us, and just like, what is this ETF fund flows driving this? Like, these valuations are insane. Yeah. But the reality is that they've also had strong earnings. They also have tailwinds. They're just part of that picture. And again, that's such a big weight to the Canadian index. But I would say that in 2025, people are buying the Canadian index because the overweight to materials, metals, and minings, and then you're kind of getting this natural overweight to financials as well. So the two of them were kind of firing. And we just saw some just general Canadian index buying as well. Okay.
I guess other question I have on that before we get to our second segment, which is our answering the internet questions. You mentioned thematics. Like, is there any, obviously, like we talk broadly about, the AI theme and like getting exposure that way, whether it's, a specific sector, like US sector, maybe it's even, some of these AI indices that now exist. From our perspective, obviously, like, our momentum factor is definitely AI sensitive just because of what's worked naturally. Is there any other themes other than AI that are playing out, or is it pretty much focused on AI?
That's a great question. I think right now it's all eyes on AI, and it's just moving so quickly. And in many ways, the traditional GICS sectors are how we used to think about the market in kind of healthcare and energy and financials. This is in communication services and infotech. Even these seem so legacy right now. We don't have a good handle on what you're actually buying and what does that basket look like and what trend and themes am I investing in. And the tricky part, though, is that AI is evolving so quickly, and I don't think anyone really has a crystal ball on how it's actually going to trickle down through the economy, through into our daily lives, and what that means for overall company earnings and overall growth. And before it was hyperscalers, and then it was like, okay, now we need to own the chip makers, and then we need to own the memory chip makers, the cooling, and then I need to own the people that can do the engineering behind building these more warehouses that are going to store the memory chips, and how far down the line and the picks and shovels can you get? And I think it's a really fascinating time to be involved, but it's just changing so quickly. It's kind of hard to get a handle on exactly what you're investing in. But the one kind of innovation that we're seeing now in both Canadian and the US ETF marketplace is getting more concentrated exposures within a single ETF. So, historically, maybe you owned a sector ETF that had 200 companies in it. Now you can get a little bit more bespoke or a bit more targeted
subsector or industry
with 10 to 20 companies. So you're not making a bet. You don't have to bet on the winner, like who is the hyperscaler that's going to be Amazon. That was Amazon back in 2001. I can own the 10 or 12, and I hope 2 or 3 of them become the de facto company in the space.
Okay. No, I like that. That makes sense. I was kind of like, I think a lot of that theme or thematic flows driven is definitely AI related. I was just curious, maybe there's some other stuff, but definitely makes a lot of sense. And it's funny because even from some of our our active managers that we hear from here at Fidelity, it's really something that's just it's kind of AI's world, and we're living in it. And it's like, how is this impacting certain other industries? And to your point, the trickle down effect is like you're seeing like last year. Base metals started to work in the US. Like Alcoa was a great performer, Caterpillar, like all these businesses that are like way down the spectrum, where initially, like you said, it was like Nvidia is going to do well. And then it was, okay, from Nvidia, it's like SanDisk.
Yes.
Like, so you had like these names that were making like, it was direct correlation. It felt like now you're getting the offshoots, and hence why like March earnings revisions go wide, massively positive. There's so much more breadth of like earnings growth. Eventually we're going to see where it ends up, but like right now it's trickling down. You're starting to see like water coming out in, certain areas, if you will.
There is on that, the theme, we're seeing some interest in the anti-AI theme too. Yeah. So it's like, hey, I want, again, a diversifier or something else. So we're seeing this halo phrase come into market, which is heavy assets, low obsolescence.
Yeah.
Which is, I don't know who coined that term because it's very difficult to get out.
Yeah.
But the reality is like, I want things in the real world. I want things that are not going to be displaced. We saw the SaaS apocalypse happen in February, where all of these software companies are going to get replaced easily with AI. That was the thesis. People just want something like, I want to own a road or the chip maker that goes all the particles that go into making asphalt, or I want to own a physical billboard that's not going anywhere because people are going to be still driving their cars into the office. I'm looking for real tangible assets in the real world. So I think that's another theme offshoot of AI, but people wanting to diversify with something that is absolutely not related to the AI trade at all.
That's a great point. It's, you got to go the other way. It's funny because we always look at it as well as like when you have these momentum like from us, like there's so much momentum there that like when there are the reversals, like you got to have something as an offshoot, or at least some type of anchor in the portfolio that's going to help you in those periods. What we found is more like obviously the like value names or like value buckets, right? So, but that's another great example, right? Like whether it's infrastructure or whether it's any of these hard asset names, definitely makes sense. So, no, awesome. So we're going to our second segment, which is answering the internet. So Valerie and I are going to take turns kind of answering some of the questions that you've submitted to us on Reddit, which we always appreciate so much. It helps liven up the show, and then we can actually answer some of your questions that you have for us. So first question that we received is, why should I invest in other funds if I can just consistently invest in the good old S&P 500?
The S&P 500 is a great place to start, and it has actually, had very successful years coming out of 2022. The thing about S&P 500 is it's market cap weighted. So if the top stocks are performing well, the S&P 500 is going to do very well, and it might be very hard to beat. In 2024, NVIDIA, was up 80%. It pretty much carried the S&P 500. And if you didn't have NVIDIA in your portfolio, you underperformed. And so it was a very easy year in my mind to be like, just own the index and you're good to go. The reality is there's a lot of things that can happen in markets. No one has a crystal ball, and diversification is so important. And so I think if you are bullish on the S&P 500, you like the U.S. growth story, that absolutely can be a core position. But you should think about other opportunities across the spectrum, again, to diversify, to build out in case something turns the corner for the largest companies. Then you should benefit from having other alternatives within a portfolio.
That makes a lot of sense. I mean, like that's obviously alluding to like market concentration, right? And like S&P 500's done phenomenally well. Everybody's seen the stats, seen the charts of like, the top 10 is now more than 30% of the index. That the Mag 7 is more than 35% of the index. And you have these stats are slightly it's not alarming, but it is a situation you just have to understand what you're holding there is maybe different than what it was 10 years ago. And another reminder that investors, advisors can look at is just looking at the top 10 over decades, right? You can see how it changes and how there's ebbs and flows, and sectors go through, these kind of secular trends. If we look at, 2000 to 2000, basically 2009, it was a very low single digit annualized number for the S&P 500. So it's not that it won't work. Like markets go up over time, but definitely to your point, diversification, there are periods where, having that diversification effect, whether it's from a geographic standpoint, from a market cap standpoint as well, right? Like it is much, the average market cap size of the S&P 500 is significantly more than it was 10 years ago, naturally, as well as from a style standpoint, because it's become more and more kind of like momentum, quality driven,
and
more
it's so tech overweight.
Absolutely. Insane. Which you mentioned the GIC sectors earlier about like how it's like, it feels like it's outdated because of the impact of AI is like trickling through also other sectors. But I mean, comm services, tech, and some of consumer discretionary, if you take the kind of those tech heavy names or brand or companies that are maybe not falling into the tech realm, but they're pretty much tech companies, it's a lot of the index. So anyway, that's great question. Thank you for that. And I think that was a great answer. Yeah, always think about diversification.
It's the only free lunch in finance.
That's a great classic phrase. I like that.
Yes. I also had an old boss that had a Venn diagram on his behind his desk, and it has making a killing and getting killed, and the overlap in the Venn diagram was diversification. So
that's
that's what's going to save you out there, kids.
Absolutely. And look, I guess certain years is just, you can see it clearly. Like some years it's tough. Even if you're just diversified in 2022, it's tough unless you're in cash.
Yeah.
But there's a lot of, like, even last year was interesting, right? Like it wasn't the whole year that the US market was just doing really well. Like international was doing exceptionally well. Canada, precious metals, like who would have thought gold was going to do as well in 24 and 25? So yeah, I need a copy of that Venn diagram so we can put it up next to our all-in-one page, maybe. Second question that we have, and it's kind of a tricky one. So maybe tricky one in the sense I'm not quite sure what our audience member here was asking exactly, but we'll try to take a crack at it. Is anyone starting to feel like playing it safe in Canada is actually the riskiest strategy? So maybe the way that we phrase this is looking at what's traditionally worked in Canada. Is that maybe now a little bit at risk?
Yes, and there is a lot of facets to this question too. And so is it playing safe just me owning Canadian banks because they do well? Is it just owning utilities because I know they've got a steady stream of cash flows coming in? Like maybe that is quote unquote playing it too safe because you've missed, again, this AI technology growth trade because you haven't been involved for whatever reason. But again, I think it comes down to just like core principles of investing. It's being diversified. It's understanding the risk that you have at play. It's being humble and being able to change course if there's something that's gone different in your investment thesis. It's understanding what you're buying and why you are buying that asset or that strategy. What's and having a plan around that. Yeah. Exactly. What is this bringing to my portfolio? What am I hoping to get out of it? You should have like kind of target returns in mind, and you should have stop losses in mind too. So these are all just good principles in investing generally.
That's a great point. And I think, when we think playing it safe in Canada, it seems like that has been like good allocation to banks. Real estate market's always good. It's like, that's kind of like the two staples of Canadian investing, with like once in a while we'll get a rally in energy, and that's like the gravy. Last time it was gold, but I think you're absolutely right. Like playing it safe doesn't necessarily, like, what is playing it safe? Like, does that mean you're not taking, maybe playing it safe was also not taking enough risk when it was the right time to take risk, or appropriate to take risk for certain risk, given your own profile. It's not financial advice by any means, but, playing it safe right now anyways, seemingly like some of those sectors might be in for a little bit of a rougher time if we're in a technical recession, or if we have a bit of inflationary pressures, or we've got a slowing, real estate market, which by pretty much every measure we can look at, whether it's starts, permits, house prices, like it's not as hot as it was.
Yes.
So maybe playing it safe is just diversifying away from to other stuff in Canada or outside Canada.
And also to that point, we've also certainly seen that in fund flows as well. We've seen Canadian investors. International, again, was the story of 2025, US 2026. Yeah. So we're seeing people broaden out maybe their investment geographies as well.
Yeah, absolutely. Great point. We didn't mention it earlier. Great point. Okay. How hard is it for folks outside the US to purchase US stocks? So let's use a Canadian investor as an example. It's a Canadian podcast. Anybody listening in Europe, I don't know if there is anyone, but if you are, Canadian buys. So for a Canadian investor, how hard is it to buy US stocks?
It's relatively easy. But there are reasons you should consider buying a Canadian equivalent instead, especially when it comes down to funds or ETFs. Yes, you can easily convert your Canadian dollars to US dollars and go purchase that stock and own that stock underlying. But there are much different protections and opportunities in owning, let's say, a comparable ETF in Canada. So there's things like Canadian products can bring currency hedging within the ETF, so you don't even have to think about it. You can use your Canadian dollars and they will hedge out the currency risk. You can and many times have a Canadian listed ETF that you can purchase in US dollars if you have a USD account. And then you can buy a Canadian ETF that's unhedged. So we've got a lot of different currency variations. There's also benefits when it comes down to things like tax treatment and when tax time rolls around, and it's way easier to manage with owning a Canadian domiciled ETF. And then the last thing is also there are better investor protections when owning or buying a Canadian ETF. So that's my little pitch for why you should look local first.
All great points. And like the reality, and you know, the questions was also like relative to stocks. It's kind of the same answer for ETFs because obviously they do trade extremely similarly for investors. Definitely way different for folks like you in the background. But those are all great points. And like just the breadth of options that are available in the Canadian market now, like there's not that many things. I will say a caveat to that is there's probably a lot more like very niche thematic stuff in the US, but like even now, like whether it's like, I don't know, covered call single stock ETFs are here, like we're actually fairly innovative in the Canadian market as well, right? Where there's a lot of things that we do that the US hasn't had the flexibility to do, like ETF share classes. That's something that's like just starting in the US, where we've been doing that for quite a while in Canada. So definitely a lot to be proud of and look at in the Canadian ETF
And I would
side.
just add, you can probably easily buy a U.S. stock pretty straightforwardly, but buying international stocks, buying an Indian company, buying a South Korean company, much more difficult for an individual investor to do. But the ETF wrapper solves for that in many cases.
Absolutely, and probably a lot cheaper as well to do.
1,000%.
Yeah. Awesome. Last question that we have before I take my turn of asking questions to Valerie. Why is overlapping ETFs a bad thing? And the example that this user from Reddit provided was, you know, if I hold S&P 500 and NASDAQ, what's the risk basically of having that much overlap in the portfolio?
It just comes back to our favorite D word, diversification, baby.
Yeah.
Because if you're holding 6 different funds and you think you've got a diversified portfolio, but the reality is that the overlap is 95%.
Oh, it's the same top 10.
The same companies, and it's not a diversified portfolio. So if the market gyrations work against how you are currently oriented, then you can have a bigger drawdown than potentially that you had expected. So it's about, we really encourage investors to do their due diligence, look under the hood, look on the top holdings list, and you can probably pretty quickly get a good sense of how much overlap there is. There's also ETF screeners that they're free, available online. And again, it can kind of compare 2 or 3 ETFs together and give you an understanding. Now, that said, it's kind of hard to imagine a scenario where each individual ETF doesn't have any crossover. There will be some natural overlapping, but it's just making sure you understand where that is and the risks associated. Maybe you want S&P 500 and NASDAQ exposure, but it's thinking about the weightings and thinking about how all these puzzle pieces fit together to deliver the investment goals that you're looking for.
Absolutely, all great points. And once again, going back to diversification is exactly right. But the point that you made right there at the end of like, but if it's intended, right? Like, like if you are, why is overlapping a bad thing? It doesn't necessarily mean it's a bad thing. You just have to know if it is or if it isn't, and do you want that or do you not want that, right? So to your point on due diligence is like, if you're trying to tactically express a view on the market and you want to get overlap or overweights, I guess, to a certain extent, and by all means, that's a way to do it. It's not necessarily a bad thing. You can have, let's say we go back to our S&P 500 as our core position, and you're like, but I really like what the NASDAQ 100 is doing, or just NASDAQ tech. Yeah. Sure, there's going to be overlap, but don't let that get in the way either if that's your thesis or your investment decision. It's just all part of consideration. For sure. And I'll bring a little Fidelity 2 cents perspective into it. Is like when we look at like all of our different quant strategies, there ends up having overlaps among even like investment factors that should be technically very different for very different reasons, like size and tracking error. Like sometimes there's some names you're going to own, you're going to be underweight, but you have to own some just because of the sheer size, and you don't want to create a bias where you become a small cap product. And also at the same time, if you have either active products, quant products, or like any product that has like inclusion criteria or screening that's like above and beyond market cap, and maybe some of the base kind of profitability ones that S&P indices will have, like if two different strategies come to the same conclusion, well, maybe there's a good reason for that. Maybe it's like a great opportunity, right? And I'm not saying that, once again, no financial advice. That's why I look at the camera every time I say that. But it's kind of the same thing as like when we have two portfolio managers that think very differently, have very different investment styles, and they both like a stock. That's usually a pretty good thing.
Yes.
And so once again, overlap, not necessarily the worst thing in the world. All right. So that concludes Answering the Internet for this episode. So we're going to get back to my turn to ask the questions to Valerie. It's not your questions. So I'll take maybe a step, and we've been talking for a while now, but I still think like maybe I should actually started with this, but understanding your role, like you mentioned Director Institutional ETF Sales and Strategy. For some of our audience, maybe it's the first time they've had the chance to hear from you, or maybe they have heard from you before, but like what exactly is it that you and your team do on a day-to-day basis, and kind of provide a bit more insights on that? Maybe.
Yeah, I think this is a great fundamental question, and it's honestly in some ways difficult to understand because I am part of RBC Capital Markets. I know RBC Global Asset Management has their own ETFs, but I'm part of RBC Capital Markets. So I'm part of the ETF market making desk. So I sit on a desk with a number of traders, and we trade and transact in well over 1,000. The number now is probably through 1,400 Canadian listed ETFs. So we partner with all the different asset managers on the street, including Fidelity, and we work together to provide liquidity effectively into the Canadian ETF market. This fits well with my background because before I came to the ETF industry, I was an institutional equity trader. So that's kind of, my bread and butter. And then I've come over the dark side, and I joke I love to pull everyone across with me to the world of ETFs. But it's a very broad mandate. So we have our trading team that I sit beside, and they're out there all day long posting two-sided markets, bids and offers. We talk to every type of investor, from big institutions, even like the biggest US institutions that want to trade Canadian ETFs. We talk to advisors, and we even talk to very large direct DIY investors as well.
Awesome. No, that's great insights. It's always interesting because I like having spoken to different market making teams and myself, like everybody kind of does the same thing, but everybody does it a little bit differently. Like, is there anything, like what would be like the one standout uniqueness that you think that you guys do very well that, gives you an edge, right?
Yeah, I think our edge is mainly in our trading technology. So we have the largest US ETF trading franchise. So we are a top 10 player, almost a top 5 market maker in the US. We have this trading technology Thor that was kind of a big part of the Flash Boys novel in 2012. And RBC was a true leader in electronic trading. And again, the US market is a lot faster than Canada. It's a lot more nimble, a lot more chaotic in a way. But we've been able to—
Chaos is fun.
Yeah, we have the technology to deal with that volatility, to deal with that liquidity, and we've ported that US trading tech. Our team in the US is 30 people of ETF traders. And we've been able to recently, in the last few years, bring that trading technology stack into Canada and kind of bring that best in class trading and risk pricing into the Canadian market. And that especially shines, I would say, in areas that are more complex to price. So that's ETFs that trade international equities, ETFs that trade derivatives based or structured product strategies within the wrapper. And so like that's where the RBC team comes to play.
Awesome. See, that's a great opportunity to talk about some positive stuff.
Thanks for letting me flex on the
there you go.
RBC
That's awesome.
team.
No, but it's like it's we don't really see it like as investors or advisors. Like it's something that or even asset managers in our case, like we're listing these products. We work with you guys, work with the other market makers in the industry, and it's just like we're just trying to get best price, best execution for everyone. so are you guys, right? So it's like kind of it's a great marketplace. And I think it just, in previous conversations, it's like if you feel like something's not priced well, it's because somebody, it's going to be fixed because somebody's going to step in and help out.
The beauty of the
arbitrage, the beautiful part of the technology
mechanism
aspect.
And then also I would just say, like, it is one of those things people sometimes ask me too, like, Val, what's in it for you? And at the end of the day, we really want people to have a positive trading experience with ETF because that means they're going to trade more ETFs. And at the end of the day, my business benefits the more people that trade and transact in ETFs. So yeah, it's a volume game. And so the more people we can have a good positive experience with their execution, that's going to be better business for me at the end of the day. So we just want to kind of spread the good word of ETFs and help people access liquidity in an efficient manner.
Perfect. My second question is, you've been RBC with, you mentioned 6 years. What's the biggest change you've seen in the Canadian ETF industry since you started?
Wow, the biggest change, I mean, it's just been the growth. It's been
so many more ETFs to cover.
So many more ETFs to cover. But really also you touched on as well the innovation. Canada has been a leader, is still a leader in many different places. So I joined 2020. It's kind of coming out of COVID. We had the big rise in the original thematic boom, ESG. Of course, we launched the first crypto ETFs here in Canada, covered call ETFs. We've been a huge leader in the space. I think I did have to eat a bit of humble pie because I was on television about 3 years ago saying, it's quite saturated with 60 ETFs in the Canadian market. And now I think we might have 3x that number. But it's a pleasant surprise because actually the Canadian market can support over 150 cover call ETFs, which has been, again, kind of nothing shy of impressive and telling me that Canadian investors still find opportunity here. They still want to be involved. And, even other places, boring places like cash proxy ETFs, we have been a leader in the space. And I think it's great just to see Canada well represented in what they're bringing to the ETF industry globally.
No, that's great. Yeah, no, it's even so when I was started, it was 2018 when we were launching our first ETFs, and it's absurd the amount of new things that have come out. It's who would have thought, even like internally, but like just broadly speaking in the industry, it's been phenomenal growth, and especially I'd say post COVID, it's been like really massive boom and consistent flows and
honestly no signs of slowing down. And even I forgot, was remiss to mention asset allocation ETFs. I truly believe this phenomenon is going to come to the US, but we're here first. And I've been calling it the Pac-Man of fund flows because just every day I'm showing up and there's just the Pac-Man coming for the asset allocation all-in-one ETFs every single month for the past 18, 24 months now, maybe at this point. Again, no signs of slowing down. And US hasn't woken up to that trend yet. And there are structural differences before someone points them out to me that exist between our two countries, but I think there's things that we're definitely ahead of the curve on.
Sure. It's so funny you bring up the asset allocation ETFs because, in speaking with our counterparts in Boston, when we're talking about like product development, we're talking about product strategy, and they're like, how do you guys do it? How are so many investors interested in these asset allocation ETFs? They're like, all people care about here is like stocks and then equity ETFs. And it's like, so it's they have a lot of like these kind of like life cycle funds and life cycle products, which kind of take up a lot of the asset allocation mix. But I think it's been a winning strategy for like a lot of players, including Fidelity, but a lot of other industry players as well, where I think so many investors are just looking for simplicity. Like we mentioned diversification about 100 times already, but realistically, like if you can just get one simple thing and look at that as a core in a portfolio, and then you can build around it if you want. But
and then we go back to like what we know works, what financial academia says what works, and these kind of consistently screen as kind of the easy button. And I think it's the Canadian prudent investor is here to like put their dollars behind that realization as well.
What do we have here? So the next one I have, this is one I've really been. I almost brought it into the part when we were talking about AI, but I wanted to leave it here because I wanted to make it more of a broader kind of conversation on the ETF industry as a whole and how this potential wave of IPOs which we got kind of the first wave, and now we're there might be some more kind of picking up. But like last week we had one of the largest IPOs in history. It's every news headline right now is basically around where SpaceX is and what the next new IPO is going to be. But from our perspective, obviously, like being in the ETF industry is like, this is going to have probably a pretty important impact, or anyways, we think it's going to have an impact. So I just wanted to get your thoughts on like, how do you deal with a new issuance like this from the market making side? Because like, without necessarily going, maybe we'll get to that after, of like inclusion into certain indices, but like it's very liquid, but it's also very volatile. So how does that play into the market making space in terms of like maybe even risk budget or pricing on like that bid or that bid and ask that you guys do?
Yeah, I think you hit on two key topics in your question. So when we think about making markets, well, no, just like it's liquidity and volatility. These are kind of two key drivers of where we can set our technology and where we can set our spreads, and having really, at the end of the day, we are pricing risk, and uncertainty is the enemy of a market maker. And so the more certainty we have around price, where we can exit, where we can hedge, where we can pick up if we need to, those are key factors. So yeah, you said liquidity and volatility. If there's no liquidity and high volatility, this is the nightmare situation. This is, I guess, if we've got our quadrants, this is the bad quadrant. And then ideally, we have lots of liquidity and low volatility, and that's very easy for us, again, to price as tightly as possible, and because we have surety of where we can enter and exit trades and hedges. And then I guess we have the other two quadrants. So SpaceX kind of falls into this. We've got a lot of liquidity, which is great, but maybe there's more volatility, or we had a few big moves since it's listed. So we will naturally have to accommodate for that. We also are kind of getting different ways to receive our information, to like understand if ETF has gotten a pre-IPO allocation, which again helps us stay on side, because again, if we don't have the information, we might be pricing an ETF here when we didn't know it had a SpaceX exposure and should be here. And so if we're selling and really the value is here, that's again, not a great situation for an ETF desk. It's a market making desk. That's
where
a loss.
somebody else might have the information.
Yes.
That's where.
Yes. So exactly. So all that to summarize is yes, that it might have us to back out our spreads a little bit. Any kind of big intraday move or big volatility will naturally cause that. But it is certainly nothing that we can't handle. And I think it's like an exciting time overall in the industry.
So building on that though, like if we're thinking, maybe taking a step back and just more thinking about like the impact that it might have on the industry from just a natural potential buying situation, where whether, and I know S&P's already said they're not including SpaceX as we speak. Like none of our products will be considering it to be included because we require minimum 15% of free float.
Yeah.
But there will be indices that are going to be adding it, whether it's like a total market or all cap, or those types of indices maybe that don't have those requirements, or it's just liquidity requirements. Does that have, in your mind, is the ETF market big enough for that to have a material impact on some of these IPOs?
Yeah, I think the question is not so much the ETF industry itself, but it's index tracking,
index tracking
at large.
Yeah,
and I think SpaceX is going to be a very interesting use case. I'm sure it's going to be used in like business school studies. Case studies 5 years from now. And that's because, again, there's a few nuances. First of all, historic IPO, of course, right? And just in size and scope alone. But the float, as you mentioned, only 5% free float is so small. And that really is going to put some price dynamics at play. And I'm almost hesitant to have this discussion as we talk about ETFs, because ETFs are so different when they're traded, and I don't want people to get confused. But in the world of single stocks, the shares outstanding are finite.
Yes.
In the ETF world, we can create and redeem. So this like price inelasticity that I'm going to talk about, that does not apply to ETFs in the same way.
Yeah, for me, it's just like a fascinating conversation. I feel like the last time we had kind of similar conversation was when the US finally approved Bitcoin ETFs, and was that buying, moving Bitcoin price. Not to say like it's going to be the same situation that happens, but like that conversation is always fascinating to me, because if you go back like 10, 15 years, nobody would have ever said that like because of all these passive, products, it's going to move certain equities.
Yes. And it's not the tail wagging the dog.
No, exactly.
And sorry to interrupt, but one more thing is, even just in Canada, I was looking at the number of ETFs that have included, or in US that have bought SpaceX. They're all active ETFs that are getting ahead of the index. And so it's not even a story of where the demand is coming from, because active 50 US listed ETFs have got exposure to SpaceX between day one and day two. Yeah. So the active guys are moving too. So you can't just point your finger at index or passive when the other side is also participating in the run.
It's more the systematic way of saying, like, if you're, you've owned, say, the NASDAQ 100, let's use that as an example. You've held it for 10, 15 years. Like, guess what? You're probably going to get some in your portfolio, whether you choose to or not. And the price that you pay is the price that's there now, right? So obviously, good and bad to that.
And again, but you're in the index, you're diversified. So, it goes in, it's part of the index, it's in your basket, but you're not,
Oh no, it's better than
married.
Fair enough. Too. Absolutely. Okay. I think we're getting pretty much to time. I'll ask you one last question. And this is just maybe because I'm curious. What is the most common question that you guys have been getting recently? Like what's on top of your clients' minds and the people that you interact with?
I would say there's two questions that we get frequently, and
I hope I didn't ask.
No.
Yeah, I wanted something different.
The first one is there are so many ETFs in Canada. How do I make sense of it? Where do I look? I'm comparing 3. Can you help me walk through them? What are the most important things when I'm comparing and looking across something that looks very similar by title, but then is very different in composition? So just I think the sheer number, 1,800 ETFs now in Canada is absolutely bananas. And so it's like helping people walk through, and
it's like 20 dividend ETFs.
And
which one makes sense to me?
To be honest, a lot of times they're same but different. There is slight tweaks around the edges, and it's about doing your due diligence and again understanding what you're buying and why you're buying it. So it's kind of fun coaching through and even just walking people through the questions that they're having, like what is most important to you? And because lots of times there's a lot of different variables in the ETF construction, and some of those variables will be toggled very differently. Again, it could just be dividend, but 20 products all have slightly different tweaks. So it's understanding what exactly you're after and finding the best ETF to fit that need, that investment need. And then the other one, of course, is best execution. How, if I've got a large amount of volume to do, what is my best way to execute, and how can I do that with your trading desk? And again, there's not one size fits all answer. It's kind of the consultative process, working through like, well, what is important to you? How do you like to trade? What the product is, because different products will have different constraints. And again, having this nice discussion and working back to something that we think best fits the client's needs and to get them the best execution at the end of the day.
Love that. Thank you so much for joining us. This is awesome. Great. Very excited to have Valerie Grimba join us. This is, once again, recapping our episode. We talked about ETF industry insights, market making insights. We talked about a few different themes as well, like how AI is played into the market. Great episode. Thank you so much for listening in. We'll catch you next time.